45% of new borrowers earn under 100K. Yet, average loans top 41K for new cars. Delinquencies at records. The mechanism? Non-bank sharks feasting on the desperate. Let's be clear about what we're looking at. The headlines scream, "Auto loan bubble bursts," conjuring images of 2008-style collapse, balance sheets exploding, credit markets seizing. But that's not what's happening. The auto debt machine isn't bursting. It's doing exactly what it was designed to do. It's extracting. $1.66 trillion in vehicle debt sits on American household balance sheets, unchanged quarter over quarter, the second largest pile of consumer obligations after mortgages. Stable, the analysts say, under control. But stability here is a polite word for stagnation. And stagnation is a polite word for a trap that's already sprung. Because while the total debt flatlines, the people carrying it are drowning. Delinquencies have hit 15-year highs. Subprime borrowers, those with credit scores marking them as risky, as desperate, are missing payments at rates not seen since the wreckage of the Great Recession. Nearly 16% of subprime auto loans are at least 30 days late. 6.5% are 60 days gone. These aren't statistics. They are repossession notices. They are families losing the car that gets them to work, the work that pays the rent that keeps the roof overhead. And the question we must ask is not whether this bubble will burst, but who designed the bubble, who profits from it, and who is left holding the bag when it deflates. The scale of this debt is worth grasping, not because big numbers impress, but because they reveal the architecture of extraction. $1.66 trillion. That's roughly 9% of total household debt, trailing only the 13 trillion in mortgages. In the second quarter of this year, Americans took out nearly 188 billion in new auto loans. The young bore the brunt. Those aged 18 to 49 accounted for over 110 billion of that. By April, 2.4 million loans worth $72 billion were originated, nearly 10% more than the year before. On the surface, that looks like demand, like a healthy market. But peel it back. By the third quarter, new originations had fallen to 184 billion with zero year-over-year growth. Subprime originations dropped 12%. Credit inquiries, people even asking for loans, fell. The machine is sputtering. The headline stability of that 1.66 trillion is not strength. It's the pause before the contraction. The moment when lenders have wrung as much as they can from borrowers who have nothing left to give. How did we get here? Start with the price of the vehicle itself. The pandemic broke global supply chains. Semiconductor shortages idled factories. Dealers, smelling opportunity, slapped markups on everything. Automakers, freed from competitive pressure by scarcity, discovered they could charge whatever they liked. The average price of a new vehicle in October of this year sat near $50,000. $50,000 for a car, for a depreciating asset that loses value the moment it leaves the lot. The average new car loan climbed to nearly $42,000. Used cars, supposedly the affordable option, averaged nearly 27,000. These aren't luxury purchases. These are Hondas and Fords and Chevrolets, the basic transport that working people need to get to jobs that don't pay enough to afford them. The price surge was structural, not temporary. It was corporate pricing power meeting supply constraints, and it reset the floor. Even as chip shortages eased, prices stayed high. Why? Because they could. Because the market is not competitive in any meaningful sense. Because a handful of manufacturers and a cartel of dealers control supply, and they have no incentive to lower prices when buyers have no choice but to pay. Then the Federal Reserve stepped in, not to help, but to tighten the noose. Inflation, the central banker said, must be fought. And so they raised interest rates again and again, from near zero to over 5%. Auto loan rates followed. The average monthly payment for a new car hit $749 in the second quarter of this year, up nearly 2% from the year before. But zoom out. In 2020, that payment was around $470. It has risen 30% in 5 years. 30%. Wages did not rise 30%. Not for the bottom half, not for the people taking out these loans. The Fed's inflation fight was a class war by another name. Higher rates were meant to cool demand, to discipline labor by threatening unemployment, to suppress wage growth. And they worked. But the cost was borne by households, not corporations. Automakers kept their prices high. Dealers kept their margins fat. Lenders stretched loan terms to 60, 70, 84 months to make the monthly payment look manageable. But the total interest burden exploded. A $41,000 loan at 7% over 60 months means paying back around $45,000. $4,000 in interest. Pure profit for the lender, pure cost for the borrower. The mechanism is simple. The Fed raises rates to protect the value of money for creditors, and working people pay the bill. Who is issuing these loans? Not the banks, not primarily. Banks, subject to capital requirements and regulatory oversight, have pulled back. Their share of subprime auto lending sits at 21%, up slightly but still cautious. The action is elsewhere. Dealer finance arms and non-bank monoline lenders, shadow institutions operating outside the prudential rules that govern banks, hold over 60% of subprime loans. Deep subprime debt, the riskiest of the risky, is up nearly 9% year over year. Why? Because these lenders can. They face no reserve requirements, no stress tests, no meaningful supervision. They originate loans, bundle them into asset-backed securities, sell them to investors hungry for yield, and pocket fees up front. If the borrower defaults, it's the investor's problem, or the borrower's problem, or nobody's problem until it's everybody's problem. This is regulatory arbitrage. This is the same playbook that ran in the lead-up to the subprime mortgage crisis. Originate, securitize, distribute risk, repeat. And it works beautifully. Right up until it doesn't. The defaults are already here. 3.88% of all auto loans were at least 30 days past due in the third quarter, the highest rate in 15 years. 5% were 90 days or more late in the second quarter, up nearly 13% from the prior year. But the real carnage is in subprime. 15.78% of subprime loans are 30 days late. 6.65% are 60 days late. These are record highs, levels not seen since the early 2000s, since the last time we let shadow lenders run wild. And it's not just numbers. Tricolor Holdings, a subprime auto lender, declared bankruptcy recently. The canary in the coal mine didn't just sing, it dropped dead. Delinquencies are the leading edge. Defaults follow. Repossessions follow defaults. And every repossession is a worker who can't get to their job, a family that loses income, a downward spiral that no amount of macroeconomic cheerleading can reverse. Who are these borrowers? 45% of those who took out loans in the first half of this year earn less than $100,000 a year. For many, far less. The average loan is around $30,000 overall, over $40,000 for new cars. Think about that. Someone earning $50,000 or $60,000 a year, taking on a loan equal to 2/3 of their annual income just to buy the car they need to get to the job that pays that income. The car is not a luxury. It is the precondition for participation in the labor market. 85% of American commutes require a car. Public transit is a joke outside a handful of cities. Employers assume you have a vehicle. No car, no job. No job, no money for the car payment. The trap is elegant. And it is not an accident. It is the result of decades of policy choices. Subsidizing highways over rail, starving public transit, allowing wage stagnation, letting housing costs force workers into distant suburbs. The car becomes a necessity, and necessities become profit centers. The borrower has no leverage. The lender has all of it. And so the terms are dictated by those who hold the capital, and the capital demands its return. This should sound familiar. In the 2000s, subprime mortgage lenders told working families they could afford homes they couldn't. Lenders originated toxic loans, sold them into mortgage-backed securities, and walked away. When defaults spiked, the financial system seized, and the public bailed out the banks. The borrowers lost their homes. The auto loan market is smaller, yes. It is not systemic in the same way, but the logic is identical. Lenders originate loans to borrowers with little ability to repay. They securitize the loans, offloading risk. They profit upfront. When defaults rise, the lenders shrug. The borrower is blamed for irresponsibility. The investor takes a haircut. The lender has already moved on. And the regulatory apparatus, such as it is, does nothing. Because the regulators are captured or indifferent or ideologically committed to the fiction that markets self-correct. They do not. Markets extract until they are stopped. Who rules here, and by what rules? The Federal Reserve sets the price of money. It raised rates to fight inflation, knowing full well that higher rates would crush household balance sheets. It chose to prioritize price stability. Stability for creditors, for bondholders, for the wealthy, over household solvency. That is a political choice dressed up as technocracy. Meanwhile, the regulatory agencies that could rein in shadow lenders, the Consumer Financial Protection Bureau, state regulators, are underfunded, undermined, or asleep. Dealer finance operates in a gray zone. Non-bank lenders face no capital requirements. There is no leverage ratio, no liquidity coverage, no stress testing. They can lend as recklessly as they like, because there is no one to stop them. This is not market failure. This is market design. The rules are written to allow extraction. The institutions are structured to enable it. And the costs are borne by those with the least power to resist. The mainstream narrative insists the economy is strong. Unemployment is low. Inflation has cooled. Growth continues. And yet, auto loan delinquencies are at 15-year highs. How do we reconcile this? We don't, because the reconciliation is a lie. Aggregate statistics hide distributional realities. The top half of the income distribution is fine. The bottom half is not. Wage growth for the median worker has lagged the cost of living. Precarity has deepened. Gig work, part-time hours, irregular schedules, these do not show up as unemployment, but they do not provide stability either. A job is not the same as a livable income. And when the cost of necessities, housing, food, healthcare, transportation, rises faster than wages, people fall behind. The car payment is often the first thing to slip, because missing it doesn't immediately put you on the street the way missing rent does. But miss enough payments, and the repo man comes. And once the car is gone, the job is next. The spiral accelerates. The macro data says recovery. The micro reality says distress. And the distress is concentrated exactly where you would expect. Among the working poor, the precariously employed, the people who were told to pull themselves up by their bootstraps and instead found themselves saddled with debt they cannot escape.
What happens when you lose a car?
You lose a job. You lose income. Your credit score craters. You cannot get another loan, or the only loan you can get is even worse. Higher rate, shorter term, smaller amount. You are trapped in a lower wage labor market, limited to jobs you can reach on foot or by unreliable public transit. Your economic mobility, already constrained, collapses. This is not an individual failure. This is a structural feature. The system requires a reserve army of labor, people desperate enough to take any job at any wage. Repossession is one mechanism that creates and maintains that desperation. It is violence, economic violence, and it is routine. Now, let's be fair. Let's steelman the other side. The defenders of the system will say, look, the debt is stable. 1.66 trillion, unchanged. There is no mass default event. Delinquencies are elevated, yes, but they are not systemic. Subprime is a smaller share of the market than subprime mortgages were in 2008. Lenders are tightening standards. Subprime originations are down 12%. Banks have capital buffers. The financial system is not at risk. This is a manageable problem, a correction, not a crisis. And there is some truth here. This is not 2008. The auto loan market is not large enough to bring down the global financial system. The banks are better capitalized. The risk is more contained. But contained for whom? The financial system may be safe, but the borrowers are not. The fact that this is not a systemic crisis for Wall Street does not mean it is not a human crisis for millions of families. Delinquencies are a leading indicator. Defaults lag. Repossessions lag further. The pain is still unfolding. And the argument that lenders are tightening standards is called comfort. They are tightening now, after they have already issued hundreds of billions in risky loans. The damage is done. The tightening is not prudence, it is retreat. It is lenders pulling back because they have extracted all they can and the default risk is rising. Meanwhile, the shadow lenders, the non-bank monolines, are still pumping out subprime loans. Deep subprime debt is up nearly 9%. The tightening is selective, not universal. And even if it were universal, it does not help the borrower who is already underwater. It just means the next desperate person cannot get a loan at all, cannot get a car, cannot get a job. The system's stability is purchased with their exclusion. That is not a defense. That is an indictment. And let's talk about who profits. Automakers have enjoyed record margins. Dealers have pocketed markups. Lenders have collected billions in interest and fees. A $41,000 loan at 7% over 5 years generates $4,000 in interest. Multiply that by millions of loans. The profit is staggering. And when loans default, the lender repossesses the car, sells it at auction, and often still pursues the borrower for the deficiency, the difference between what the car sold for and what was owed. The borrower loses the car, loses their credit, and still owes money. The lender loses little. If the lender is a non-bank that securitized the loan, it loses nothing. It already sold the risk. The investor takes the hit, but the investor is a pension fund, or an insurance company, or a hedge fund, entities with diversified portfolios and deep pockets. The borrower has no diversification. The borrower has no cushion. The borrower is ruined. This is not a market. This is a wealth transfer, from the bottom to the top, mediated by debt. So what does this mean? It means the auto loan market is a microcosm of financialized capitalism. Necessities are turned into profit centers. Risk is offloaded onto the vulnerable. The state, through the Fed and through regulatory neglect, enables extraction. And when the system produces crisis, the costs are socialized, borne by borrowers, by communities, by the public, while the profits remain private. It means that the so-called recovery is a fiction for tens of millions of people. It means that the stability the technocrats celebrate is the stability of predation, not prosperity. What should we watch? Watch the delinquency to default transition. Delinquencies are high now. Defaults will follow in the next 6 to 12 months. Watch whether the Federal Reserve cuts rates or continues to prioritize creditor interests over household solvency. Watch whether there is any political response to the coming wave of repossessions, or whether it is met with the usual victim blaming and calls for personal responsibility. Watch whether the shadow lenders face any regulatory scrutiny, or whether they are allowed to continue operating in the gray zone, extracting and securitizing until the next crisis. What must be demanded? Cap auto loan interest rates. Regulate non-bank lenders as strictly as banks. Provide public financing for essential transportation, low-interest loans, or subsidies for working families who need a car to work. Invest in public transit so that car ownership is not a precondition for employment. Break the cycle of debt peonage that traps millions in a system designed to extract rather than serve. These are not radical demands. They are the bare minimum required to treat transportation as a public good rather than a profit opportunity. When will we stop pretending that a system designed to extract is a system designed to serve?